Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jinhai Medical Technology Limited annual report. Jinhai Medical Technology Limited offers a diverse range of businesses and services across various sectors. In the medical field, the company provides minimally invasive surgery solutions, medical products, and related services in China and Singapore. In addition to its medical offerings, Jinhai Medical Technology Limited also provides non-medical services such as manpower outsourcing for building and construction contractors. This includes ancillary services like warehousing, cleaning, and building maintenance. The company's portfolio extends further into IT services, engineering design consultancy, and the sale of graphene material products. It also offers dormitory services to its clients. Overall, Jinhai Medical Technology Limited has diversified its business operations across multiple industries, positioning itself as a comprehensive service provider. Jinhai Medical Technology Limited market capitalization of $22 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Jinhai Medical Technology Limited holds a significant advantage in their industry. Jinhai Medical Technology Limited trades at a higher price-to-book ratio of 69.23 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On one hand, revenue growth is primarily driven by the sale of medical equipment, particularly in China, where there is a growing demand for minimally invasive surgical instruments. Additionally, the shift towards low-carbon technologies and sustainable consumption has led to an increase in packaging material usage and adoption of efficient production methods. The growth in China's market has also contributed significantly to revenue growth, with top customers accounting for approximately 62% of total revenue. Furthermore, the development of low-carbon products and supply chains, participation in renewable energy projects, and reduced reliance on fossil fuels have all contributed to revenue growth. On the other hand, revenue decline is primarily driven by a decrease in revenue from manpower outsourcing and ancillary services due to a downturn in Singapore business. Additionally, significant decreases in revenue from dormitory services due to low market demand and ceased operation have also contributed to revenue decline. Furthermore, Customer A's revenue decreased by 28% over the period, indicating a decline in sales. Overall, it is clear that revenue growth and decline are driven by various factors, including market trends, technological advancements, and changes in customer behavior. The net income of the company experienced a decline between FY 2024 and FY 2025, primarily due to transition and operating costs. Additionally, the profitability from high-emission products and services was reduced during this period. This decrease in net income is consistent with expectations. However, there is also an instance where no change in net income was reported. Despite this inconsistency, the overall trend suggests a decline in net income. The profit margins of the company saw a significant drop between FY 2024 and FY 2025, from 22.8% to 15.5%. This decrease can be attributed to increased costs of raw materials and reduced demand for high-emission products and services. These factors have had a substantial impact on the company's profitability. The company's financial performance indicates a mixed picture when it comes to generating positive operating cash flow. On some pages, such as page 116 and 120, the numbers suggest that the company is indeed producing positive operating cash flow, with inflows of $23,141 and $24,417 respectively in 2025. However, on other pages, the data tells a different story. For instance, on page 164, the net cash generated from operating activities is only $2,454, which may not be sufficient to meet the company's financial obligations. Similarly, on page 167, the operating cash inflow is reported as $9,055, but this figure is lower than what was observed on some other pages. Overall, while there are instances where the company generates positive operating cash flow, the inconsistency across different pages raises concerns about its ability to sustain a consistent level of performance. The company's debt level and interest expenses have undergone some fluctuations over the years. While there are inconsistencies across different pages, a general trend can be observed. The debt level has generally decreased or remained stable, with one notable exception of a significant increase from $3,240,000 to $13,738,000. This anomaly aside, the overall picture suggests that the company's debt burden is not increasing significantly. In terms of interest expenses, there is a general trend of decrease, except for an isolated instance where interest charged increased by $283. The most consistent changes indicate that the company has managed to reduce its interest expenses over time. However, it is essential to note that these fluctuations may be influenced by various factors, such as market conditions and financial decisions made by the company. Overall, while there are some inconsistencies in the data, the general trend suggests that the company's debt level and interest expenses have not changed significantly. The company appears to be managing its finances effectively, with a focus on reducing its debt burden and minimizing interest expenses. Management's outlook on the company is cautiously optimistic, citing stable performance despite market volatility. They emphasize the importance of investing in digital transformation to drive future growth. The company has also factored climate-related considerations into its remuneration policy, setting targets to monitor progress towards strategic goals. In terms of risk management, management notes that it will consider hedging significant foreign currency exposure if needed. Additionally, the company's credit risk is significantly reduced due to policies in place and counterparties having high credit ratings. The company aims to continuously improve its risk management and internal control systems to ensure their effectiveness. Overall, management's strategy focuses on driving growth through digital transformation while maintaining a stable financial position by managing risks effectively. Concerns about inventory buildup and supply chain disruption are valid due to climate-related physical risks. The transportation of raw materials and components in China may be interrupted, affecting supply chains. Additionally, service delivery in Singapore could be directly disrupted. The transition climate risks also pose a threat by increasing operational costs through changes in policy, technology development, and digitalization. This can impact supply and demand, further exacerbating the issue. The potential for transport and supply chain disruptions to reduce revenue is significant, as it can lead to inventory buildup of raw materials and finished goods. The report highlights that inventory buildup is indeed a concern, with an increase in raw materials and finished goods inventory noted. These risks underscore the importance of considering climate-related physical risks when evaluating business operations and supply chains. That concludes the financial summary for Jinhai Medical Technology Limited. Feel free to comment below, and I will be happy to answer them when possible.